Good afternoon, dear colleagues and friends, dear members of CFA Association Russia. We are back at our regular video studio of CFA Association Russia with our monthly macroeconomic update. Let me remind you that, well, first of all, this is a webcast for all the financial community, but the recordings will be available along with the whole library of our past events to members of CFA Association Russia only. And second, that tomorrow, please take a look at our website. There will be another very interesting webcast, but in Russian language. Today, I am very pleased to welcome back our regular guest, CIO of asset management company from Zurich, Blackfort Capital. Let me introduce Andreas Bickel, CIO of Blackfort Capital, who has over 25 years of experience in portfolio structuring and in asset management, who worked in the top institutions in asset management. And let me give the floor. Andreas, I know that, well, we all see that the markets sometimes become euphoric. People become euphoric for the end of the lockdown. Should we be optimistic?
Well, hello from my side. Should we be optimistic? Well, that's the 1 billion question. I will give you some hints what I think of it. Of course, my crystal ball, as always, is as good as yours, but nevertheless, let's have a look what happened and what I think might happen. So today's topic is, in the light of the recent Fed announcement, the press conference, it was basically used as an excuse for a sell-off. I would rather say this sell-off was overdue and it was a good opportunity. But the key message for me from the Fed was that they, without any urgency, stressed that they will keep their rates at least until 2022 at zero. This can be seen in the dot plot. But also in 2023, so far there is not a big rise in expected Fed rates. So we will talk about these implications, why we had seen a sell-off, starting point FOMO or fear of missing out. I have seen, and I will show you two example euphoria, similar to what I have seen in 1999, so ages ago. However, this is in a very narrow sector, but it's important to keep an eye on it. I believe that we have to live with what I call financial depression for the next 3 to 5 years at least. I will explain what I mean by that and how this will manifest. Then the end of the lockdown, we have obviously the Asian world, we have Europe, and we have the rest of the world, if I may say so. There are some parallels, but there are some developments, especially in the US, which are worrisome. Last but not least, I still believe that we will see a weaker dollar. I will give you an update on that. And as always, some areas to invest. There was a slight shift from last time in the intonation, not in the basic menu, but in the intonation, what we recommend. So, what happened? I mean, as I said, the Fed will keep rates at zero at least until the end of 2022. This was used as an argument for a sell-off. Some wrote it triggered the sell-off. I would be a bit careful. I would rather say it was used as an excuse. However, we have seen euphoria. We have seen a very, very strong rise in S&P, and therefore it was really overdue. On the Robinhood platform, I haven't known that word or that platform since, well, I would say, I know it since 10 days. It is basically a platform where a retail investor can trade shares, but not one share of one particular company, no, a fraction of share. They have driven some shares, and in general, the market extremely up. This was, however, gone without the participation of the so-called professional investor or the smart money, as Wall Street calls it. You see that on the right-hand side in this chart. This is the Bank of America Merrill Lynch bull and bear indicators. The latest reading from last Thursday, so before the sell-off, was in the green at 0.4. In January, in the red at 7.1. Now after that rally, normally we would be somewhere in the extreme bullish area. However, all these ingredients which go into this indicator are driven and taken from the institutional world, and you can see that the indicator stayed in the bearish or in the green area, based on such soft indicators, we have still a buy area. Or, and that's the flip side, nobody really participated from the professional world. Given what the Fed said, I will come back to it, but I think it's important that you understand the concept, which I call financial repression. You can give it another name, but it will stay here for a long time, that we will see artificial low rates, maybe in combination with unconventional measurements from central banks and with rising inflation. We get what in the past used to be called financial repression, i.e. a transfer from wealth from private sector to the public sector. Here you see pretty well what happened. This is the so-called hedge fund euro index. When the blue line rises, institutional money is outperforming. And when it falls, the opposite is happening. Retail investors are outperforming. As you can see in the last 2-3 weeks, it was basically falling off the cliff, which means that the difference between the performance of so-called them money or retail investors versus the so-called smart money hedge fund guys was extremely in disfavor of the hedge fund guys. You see this also here. This is the open calls from small traders. It has skyrocketed. I read today that Sachs has estimated that we have now day traders back. That's not really completely new because they didn't completely vanish. However, the new part is there are 14 million new day traders, and 14 million is quite a lot of people. What do? Well, they trade on the platform Robinhood. This is an example of a stock called Nikola. Nikola produces or rather plans to produce lorries with hydrogen engine, so no CO2 emission. They never produced a prototype, they never sold a car, they are cash burning, but look what happened to the price, and look at the volume. And this volume is purely driven by small investors, and most of it over the Robinhood platform. There are other examples like Hertz, which is under Chapter 11. They have just recently got allowed to issue 1 billion of new shares, although they are filing for bankruptcy. Also this because of the demand of retail investors. Why are retail investors performing so well? You see here, according to a survey, what they bought. Most of these companies are fallen angels, so companies which used to be investment grade and are now in the non-investment grade area, and I bought basically the stocks of it. And you can also buy, for instance, for new issues, you could also buy the bonds with on the roof. On the other hand, smart investors / professionals bought quality, cash flow positive, famous name like you see over there. One is of the Google area, Alphabet as an example. They completely underperformed the retail investor. One of the explanation of this is because in the US you got to the special legislation $600 per week or $2,400 in 4 weeks for not working. That's much more than most people earn afterward. On top of it, each individual got $1,200. If they were a couple, they got $2,400, and if they had 2 kids, would get for each kid $500 on top of it. This within 6 weeks was this payment coming to such households. What did they do? According to a lot of analysis, some little bit was consumed, but most of it was used to open a Robinhood account. There were more than 10 million new accounts on this platform to basically speculate. I have read several times over the last 2-3 weeks, we see an outflow of money market products into equities. This chart is from last Thursday. So if I look at it, money market might roll over, but the huge outflow I do really not see or recognize. The light blue line is the equity market. I would rather argue there was no large inflow into that area, although you read that. Nevertheless, the inflow, if there was any, it was in corporate bonds. And we have seen, alongside with equities, corporate bonds, in particular in the AA area, most of them fallen angel, but not all of them, have performed tremendously. So one key message you can take out of it, if you read massive flows out of money markets into something or vice versa, if you get hold of such charts, do the fact check. In this case, I would argue the reality is a bit different than the headline. This, unfortunately, is more of a truth. You see here in the light blue line the Federal Reserve balance sheet expansion, and with it the S&P 500. So the correlation, if you will, is extremely strong, or was extremely strong over the last 10 weeks. We always hear or have heard the Eurozone is not doing enough. If you look on the right-hand side, you see here the ECB balance sheet. The actual approved purchasing programs are in red, and the additional one of last week, which was surprisingly higher than what one has expected, will put the balance sheet growth in a similar range than in the US. This is unprecedented for European stock markets, or let's say for the central bank. However, it shows really that the ECB does what Mr. Draghi once called whatever it takes. Although that statement now goes to Mr. Powell, because he basically said when he announced the zero rates, they will do whatever it takes. Nevertheless, this is not the whole story. On the on the left-hand side, you see the recovery fund. If the Eurozone were to approve the recovery fund, and there is some resistance from Holland, from Austria, and some other richer countries, nevertheless, it's supported by France, by Germany, and obviously by the southern country. The fiscal stimulus would be around 12% of GDP. But it's also important to notice the US, early May and early June, the stimulus stayed at the same level, which basically means they reacted very quickly, and since then they haven't improved or increased fiscal stimulus. However, there is a fifth package pending in the parliament, more than 2 trillion. If the coronavirus outbreak continues, as we will see later on, it is quite likely that this fifth package will pass and the US might lead again. You can also see that the UK has, in the last 2 months, catched up and is now even at a higher stimulus level than the US. China, on the other hand, they have announced quite some stimulus, but if you look at in relative terms, in percentage of GDP, they are below 6%, which is still a lot, but compared to the Western world, much less. I was bullish the whole time, and I know that economists and strategists and so-called intelligent money, they were bearish. Why I was bullish? Well, here you see a similar chart like before. Difference now, we are talking of the MSCI World, and we are talking of the G4 central banks. But even here, as soon as we had the lockdown, there was a tremendous stimulus package, and especially a tremendous expansion of balance sheet. And this went hand in hand with here shown equity prices going globally up, or if you will, bond markets refunctioning and spread tightening and bond performance. I For this time, I would like to introduce a concept which is called financial repression. I came across this expression in 2012, so quite a while ago. There are different aspects to it, and I will only stress the ones which I think are extremely important for the actual situation. One key element is interest rates controlled by central banks are kept on a very low level in order to inflate away the large debt burden. What we see at the moment in the US, that on one hand there is disinflation. However, the disinflation means we still have inflation, but it's getting less and less. We have Fed rates at zero, and the US shadow short rate, that's an indication which measures the impact of QE, so unconventional measurement, on the real interest rate. It stands at around -1. So on one hand, you have a negative or a zero nominal rate, and you have some inflation. These are already two key ingredients for financial repression. Financial repression was actually the area after World War II. World War II, you had debt to GDP spending. You see that on the left-hand side at an extremely high level. Similar situation in World War I, but roughly 20% lower. After that, we had the Korean War and other things, but on the market itself, we had rising equities, which ended with the Nifty 50s. We had rates which were kept artificial low, and we had especially debt to GDP in real terms shrinking over the whole time. And we can argue that we are at a similar starting point with the COVID-19. One could, I think it's a bit too much search, but one could even make a parallel between the global financial recession and the Great Depression, and then how the second step was solved with spending. I would be a bit careful with that, because World War II and the actual situation, although some governments use war language, is not really the same thing. What is unprecedented is on the right-hand side. You see the balance sheet in percentage of GDP, including the Great Depression. You see we are now at really, really high levels. And this obviously has driven stock markets up. Or you can put it this way around. Probably you're all aware of QE 1 to 3. The actual QE is similar size and is not finished, but the speed, look at the speed. I mean, it's less than 10 weeks, and before we had even years until we reached that kind of stimulus. So this is really unprecedented, and the crystal ball, if you will, tells me this will not go unnoticed in the market. This will flow, this money will flow into assets, and it might cause inflation. Therefore, a partial answer to the question at the beginning is I wouldn't be too bearish right now. Let me add some more flavor to this financial repression. So where interest rates are kept artificially depressed, I mean, Mr. Draghi, Mr. Powell, said it, we will keep it till 2022 at least, below at zero. Unconventional measurement, just to be reminded, I took that out of my archive. This was written in 2012. It includes or could include some unconventional measurement like direct buying of government bonds. I mean, when we wrote that, little did we know what will come and what has happened and what's especially going on right now. On the top of it, obviously, financial repression works best when it's combined with a modestly elevated rates of inflation that persists over a longer period of time, and that real interest rates are negative. And this is like a tax on holders of domestic bond, or if you will, Julius Baer has described it as the transfer from money from the private sector to the public sector. It's exactly what's going on. If you hold these bonds, you get your interest, you get repaid. However, in real terms, you're poorer than at the beginning. Now we can discuss, is this financial repression? Do you want to give it another name? There, I'm really relaxed. I think the expression is correctly chosen, but the important bit is when you earn money, be aware of the effect. And the effect is that you get somehow expropriated through these effects, very, very low rates, and you have to go into risky assets, otherwise you will not in real term over time preserve your capital. What is missing at the moment is inflation. I have shown this chart before. So the chart above is from JP Morgan, underneath it's from Morgan Stanley, and over the weekend I have read what the Blackfort Institute says to this theme. Basically, the three of them, and I would agree, otherwise I wouldn't show it, they say that over the next 6 to 8 quarters, the likelihood of a pickup in inflation, in particular in the US, is extremely likely. On top of it, they assume that the level of the nominal inflation will be higher than before. But at the same time, they don't expect that rates will go up. Therefore, if you hold safe government bonds or short-dated money market instruments, you can be sure in real terms, and in some cases in absolute term, if you hold, for instance, money market funds, you will have less money in your pocket down the road. In such an environment, one of the conclusions of this financial repression theme is you have to hold real assets. And there's also a big debate, what are real assets? For my understanding, I include gold, I would include real estate, I would include equities, there is a debate, and I would also include corporate bonds, probably in the lower areas or lower investment grade or BB area, because you're getting closer to equity risk. Nevertheless, given what is discussed, yield curve control in the US, it's discussed, not decided. Maybe they don't even need to implement it with their statement that they will keep rates at zero for the next 2.5 years. They have somehow the curve controlled by just discussing it. The shadow short rate is negative for most areas of the world, including the US, and therefore gold might continue to play a role in your asset allocation. You also see there was a spike in the gold price from roughly 1690 to 1715. That was on the sell-off, and then it came slightly back during the recovery on Friday. Today we are slightly down to flattish. The futures were extremely negative on the equity side in the morning and are now recovering. Let's see where we close. This is open. Here you see the picture of the US market. Again, the question, shall we be positive or bearish? If you just look at charts, so far the damage is not done. We are still above the violet line. The violet line is the 50-day average, and the green one and the yellow one are the 200 and the 100-day average. So far, this is a normal correction within a bull market. I have just read, while I was waiting for the prompt sign, that Etienne Adeni, one of the most famous strategists in the US, was asked the same question I was asked at the beginning of this presentation. And his conclusion is as well, no, this is not the beginning of the next meltdown or the next strong sell-off. And the main reason for that is stimulus, fiscal and monetary. I fully agree with that statement. Here you see it in a different range. This sell-off, the orange line, is the S&P before correction. The blue shaded area is minimum, maximum of a recovery rally, and you have an average. So yes, it was extremely fast to sell down, and it was extremely fast to recovery. It was overdue that we see a correction. It is open what comes next. But so far, this bear market and this bull market are special in case of speed, not in case or in the terms of the magnitude. My educated guess is we have now a consolidation and we might continue going further up. I showed in the beginning the bull-bear indicator. With it, they compared the stand of this indicator with the possible outcome of this rally. So the blue one is the S&P, and then the other three are strong rallies in the past. If you don't believe in charts, forget about everything. If you look at charts, it's a nice playing around. So basically, the magnitude of the rise of this rally or bear market rally question mark is still in a way that you can expect more. But it all depends on the further development of the COVID outbreak globally. We have also seen, last time I have spoken, the high yield spreads. So when last time, for instance, the US spreads were at 207%. Now, after the sell-off, we are at 175. Before we were even at 150. Today, the bond markets are already recovering, and it is open what's next. But similar to some other strategies I follow, I believe there is at the moment still value in corporate bonds, and I would add, different to last time, risk-adjusted. I would prefer credit over equities, although I'm not bearish on equity, but short-term. It might stay volatile, and the risk reward, given the valuation of the equities, I would rather go for the corporate of the balance sheet. The Fed stressed several times everything we did, so to put the rates to zero within 3 weeks, was done not to stimulate the stock market. They don't care about the stock market. However, they do care about the functioning of the capital markets, in particular the corporate bond markets. When they introduced the latest rate cut, Boeing was at the edge to go bankrupt and to ask for help from the state and or to get credit indirectly from the Fed. As we all know, in hindsight, they didn't have to do that. Why? Because of the rate cut A from the Fed, but B in particular of the guidance. So only by verbal intervention they made the bond market work again. And we have seen, besides Boeing, Ford and other fallen angels getting access to liquidity and issued a lot of bonds. This is the main focus of it. But this has a price, and I think I said it last time, there are zombie firms around. So far I have seen this expression only in German research papers. Now I have seen it here. It is from Deutsche Bank, so we can argue about the German. Nevertheless, they publish everything in English. And how you call them is not really important. They are roughly 18 to 20% of all US companies who have outstanding bonds, who are not able to earn enough earnings to serve their interest payments. What they do is they issue new debts at very low rates, and they keep themselves alive, and that's why they are called zombie companies. Therefore, the conclusion I gave last time, and I'm sorry to be a bit boring, but I will keep repeating it this time as well. We like double B companies. We think there is value there. However, please do your homework. The balance sheet must be sound. You must double check if the cash flow is sufficient to pay the interest rates and maybe a dividend of the company. And obviously the business model should be sound, etc., etc. But try to avoid zombies. The first time I was invited here to present, I presented the thesis that over the midterm, the dollar should sell off, and it has sold off in the last 4 weeks, in particular when it was clear that the Fed will stay accommodative for a longer. But when we have seen last Thursday the sell-off in equities, what happened was flight to the dollar, Swiss franc, and to JPY. It is open if that continues, and currencies in the short run, you can use chart. In the mid run, it is a bit tricky, and I know that the forecast for the dollar was bearish for a long time. It has for the first time materialized, but if you look in the chart, also when we had the outbreak of the COVID or the lockdown, the first effect was a sell-off. Nevertheless, if the dollar keeps, let's say, at this level or slightly weakening, that is helping emerging markets in general, where we like the corporate bonds. But what do we know? The key is how will COVID develop over time. This is a global chart showing the new cases. Excuse me. And you can see that it's creeping up. This is a chart of early reopened states in the US, and you can see the first wave was not finished. They reopened, and now the continuation, most of them call it, of the first wave is scary. And we had this morning the news that they might reclose. There might be another lockdown in the states, in these particular states where they were already reopened, and immediately you saw a sold off in futures. It is open. The political decision is clear. I mean, they want to open up, but the virus, unfortunately, is not to be controlled by command. It is rather by social distancing. If you look at the global situation, I mean, first time we talked here, it was Europe, the hotspot, then it was the US. Unfortunately, it's still the US. They had 20,000 new cases yesterday. They had a similar amount over the last couple of days. Brazil had up to 30,000 new cases 2-3 days ago. Now they are at 17,000 new cases every day. That's really a lot. Russia, although you probably know much more than I do, but you keep having around 9,000 cases every day. These are the knowns. The new unknowns to us are India is already on place 4 in terms of total cases. And the second hotspot is, in general, Latin America, where it starts to pick up. Europe, on the other hand, you see Spain had 323 new cases, no new deaths. Italy had, in brackets, 44 deaths and 340 new cases, so it is controlled in that area. If the Europe is behaving like the Asian area, then look at South Korea, look at Israel and China. The three had severe measurements. The three do social distancing and tracking, and if there is an outbreak, they close immediately areas, and you see that the number of new cases is extremely contained and at very low levels. I have put here Switzerland. We are somewhere in the middle in terms of measurements, so there was never a complete lockdown. However, as you probably can see in the background, I'm still at home. It is not that I have to stay here, but it's recommended that whenever possible to avoid public transport and not to go to the office. And if you go to the office, that the office shouldn't be completely full, that there should be maybe 1/3 or up to 50% of people there. These are all measurements which we do free, deliberately, decision by individuals. We have now for more than 2 weeks the case numbers between 10 and 35, and no new deaths. So in Europe, today is the day where the borders open almost completely in the Schengen area. If you want to go travel for vacation, it is now free. However, the booking situation is in a way, at least Swiss people have booked at home. They make mostly, not all, holidays at home, although you can now travel. The scary bit is this. The green line you see, that's the projection of development of cases in the US. If that happens, you have a reproduction figure of roughly 1. It should be below 1, that it increases towards 0. But with the new situation, it can happen but we see a second wave coming. Nobody can know, but that's basically the uncertainty or the unknown for us. If other states are a guide to us, starting here in Europe and then maybe going on in other areas, you see here the production of electricity by the use of coal. It is basically back to the pre-crisis level. You see here on the right-hand side the same in a different chart, but basically the message is the same, that the usage of coal for electricity production is at pre-crisis level. On the left-hand side, you see the consumer. The Chinese consumer is back, but there is still 20% roughly missing. So yes, there is a recovery, more into the industrial area, less in certain service sectors. Europe, this chart is from last week. The borders are still closed and people are asked to stay at home in most of this area. You see the toll roads in Italy, Spain and France. Yes, I see as well here a significant pickup, but it is still a long way to go and to be back on the previous crisis level. Here you see the same for most areas of the world. Leading is Sweden. They never had a complete lockdown, and lacking is Spain. Why do we look at it? Very simple. Normal statistics, normal macro data, normal sentiment indicator, which I will show you at the end, they are distorted. They don't give you any hint. Therefore, our industry looks for proxies to have an idea. And if you believe these proxies do give you any hint for the future, I would definitely conclude at worst we have a U-shaped recovery. I will say more to it in a minute. Here you see more alternative measurements, and most of them they rather show you a U-shaped recovery. For instance, on the right-hand side at the bottom is grocery shops and pharmacy shops. They have a recovery. They are back to quite high levels, but it's definitely not V-shaped. And this is all true for other measurements. Then probably you have heard, you have seen, the OECD has revised its forecast. Is it a W or is it a U or a very flat V? It's completely open, but basically they are extremely bearish. I hope you don't have the same problem I have. So they are extremely bearish. They were bearish before. The only thing I would like to add here, if you run money, you are not here to forecast the world. You might estimate the direction. Is it rather positive or rather negative? And then the slope of such a graph is giving you a hint where to allocate money. So far, all these extreme negative forecasts had to be revised up. Here is the best example. On the left-hand side, this is Morgan Stanley from today, probably published over the weekend. I had this chart in the pack, but 3 weeks old. They expected a V-shape, and that probably by the end of next year we might be at zero. They have completely revised that up, and now it comes the clue. The economist who wrote that said because of surprising data, they were less negative than their forecasts, they had to revise their V-shaped recovery. They call it now a deep V-shaped recession. Never heard this word before, but you see it in the chart. The first part is probably a fact. The second bit is revised. In particular, the steeper, the faster recovery in the second half year of next year. I would position myself in the middle, so I'm a kind of U-shaped guy, although I think this letter salad doesn't really help you, but somewhere you have to have a scenario and then to derive where to invest. A word of warning why I'm more U than V-shaped, you see on the right-hand side, different recessions in the past and the length till it recovers. And the key message here is it takes normally 18 to 24 months to be back to previous levels. And if you invest in equities, you know that 9 to 12 months probably ahead, markets start to price that in. Therefore, it is probably fair to have a slightly positive outlook for companies. In the US, I'm not surprised to see this picture. The message is the consumer, measured by alternative measurements, obviously, is back to a level of roughly 90% before. And now it comes the bit which I had to smile this morning. I read, surprisingly, the Consumer Confidence Sentiment Index rose sharply. I mean, the only thing which is really surprising is that now the index corresponds to the alternative measurements. But it did rise and that it's still at the extreme low level should come with a surprise once the sentiment indicators, asset allocator like myself, use. But the good news for me is that maybe forward-looking I can continue or restart to look at things which have some correlation, some history, and give me some indication where I should allocate money in case I see, for instance, a positive sloping PMI data. So far they were completely distorted. This is the first example where it seems that the indicator, which is still a soft indicator not used by most economists, correspond then to what we use at the moment are these alternative measurements. And if that continues, I have more hints that we are in a kind of recovery mode. Don't forget, you will get Q2 GDP, they will be horribly low. Also Q3 won't be a big positive surprise, but maybe already there in Q3, and this is a long way from here, the delta might be positive and it will be still shrinking and the whole year will still be shrinking. But if you invest, if the delta gets positive, it is rather constructive for risky assets. With that, I come to the conclusion. I have rephrased it a bit, although I already said in the beginning, the key ingredients didn't change. Why didn't they change? Well, my picture of the world is financial repression. I explained a bit what I mean by that, and if you believe in that, you have to buy real assets, and we can argue what they are. For me, at the moment, I would agree with the strategists I read, and they keep telling me for 2-3 months, best value is in corporates. That's in difference to what I said last time. And then for me, it's equities. And if I have to choose a region, knowing that the Schiller PE is extremely high, but still I would go for US assets before other assets, and maybe then Asian assets before European assets. Why? Because of the protection or the floor of the Fed. I said before, double B's, double B plus corporates are for us attractive, assuming that they are not zombies, so please do your homework. Emerging market corporates do as well offer value, in particular when the dollar keeps weakening. I'm not a gold bull, but if financial repression holds on and or we see some inflation down the road, it might be not unwise to allocate some money to gold. All the warnings I kept here again, I mean, there is no value case. There's no value for bonds. There's no value for equities. But the alternative cash is probably also no value. There is a likelihood which has risen over the last days due to the COVID situation that we see a fifth fiscal stimulus package in the US Parliament passing. US government bond yields might go lower if the Fed keeps really rates at zero. When they keep buying bonds, let's see what this means for government bonds. But we shouldn't forget, they haven't used much of their firepower for buying fallen angels or high yield ETFs, so there's still more to come. Globally, the monetary and fiscal stimulus is unprecedented. Somewhere, these assets or this money will flow. Therefore, a melt up in financial assets or / real assets is quite likely. And down the road, the warning that at least in the US, after the actual disinflationary phases, we might see higher CPEs and PPI data next year is extremely high. And with that, I thank you all, and I'm open for questions.
Thank you so much, Andreas. Let me remind those who missed the beginning that we are broadcasting our monthly macroeconomic overview from the CFA Association Russia studio on 4 platforms, on Facebook, YouTube, Vkontakte, and on our website. And so please ask your questions on either of the platforms. We will ask them. We will transfer them here to Andreas. And for those who missed, we have a conversation today with Andreas Bickel, CIO of Zurich-based asset management company Blackfort Capital. We've got quite a number of questions already, some of them quite sharp. So one of them would be from Igor on our website. He's asking, in the times of financial stimulus and helicopter money, are the fundamentals still relevant, or it's the other way around?
My personal answer to this, and this is questionable, but I would say at the moment, fundamentals are ignored. It's more flow of funds, and it's more behavioral finance, and it's obviously the stimulus. And you see that in valuation, you see that where people allocate money, I would say, unfortunately, everything you learn in, for instance, your CFA curriculum, discounted cash flow, Schiller PEs, you name it, is for the time being, let's not use the word unuseful, but it is out of function. It will play out over the midterm. Valuation is always playing out. If I'm not completely mistaken, in the book, which is also in the or at least used to be in the CFA curriculum, the Intelligent Investor, they say the stock market is short-term a waiting machine and long-term a value machine. And we are now, if you excuse it, is parallel in the waiting process, and the fundamentals value is not really playing out.
Right. You mentioned financial repression policies, which obviously make some savers sad. Do these policies work similarly in all countries, or are there countries where this is not as visible?
That's an extremely tricky question, because it really depends how many ingredients each country has. In the G4 area, I would argue the ingredients are in place. Counter example is Japan. Since 1990, they try desperately to create inflation and to inflate the way their debt to GDP problem without success. But the stimulus, at least, is in all countries I'm aware of there. And the interest rates, even in emerging markets, even in corporate bonds, where you could argue if the corporate really has a value, has reached levels where the functionality of the yield, or if of the interest rate, is not really giving you any indication. And we are back to the first question: does valuation at the moment play out? Most likely not.
Right. Okay. The other question: did the money of the QE basically go anywhere else but the stock markets? What do you think?
Former Fed Chair Bernanke would say QE doesn't work in theory, but it works in the practical world. And The honest answer is we don't know. The second answer is, at least in the US, I have shown you some let's call it flow data and some indication that the American consumer definitely didn't use this money to consume or to do what was meant to be. It really went to the stock market. And don't forget, the QE at least is meant to manipulate or to steer, if you will, the bond market, or Mr. Powell would say, to keep it function. But by definition, they keep buying bonds, and nowadays they keep even buying fallen angels and indirectly ETFs. So most of it probably went to the stock market. However, there are also programs where you got direct credit for companies, Corona credits in different shades, at least in Europe, also in the US, by the way. You could apply for credits indirectly via Blackfort from the Fed, and the Fed would guarantee for your credit. And that bit went definitely into corporates. You have support that you are not unemployed, at least in Germany, Switzerland, and in some other areas. Also in the US, the $600, you are temporarily laid off, you get $600, and the assumption is that you come back to work, although they're not for $600 a week, for much less. So it is a very good question, but the answer is not straightforward. It depends which part of the stimulus. Some of the fiscal definitely arrived where it should, but for sure not all.
Also, Igor, from our website, we all saw that big tech stocks skyrocketed compared to other stocks, the stagnation of other markets. Well, for the obvious reason that their businesses became suddenly very relevant. But do you think it's a very short-term burst, or that should stay for a while?
That's even more tricky than before, huh? I mean, we have seen the FANGs going up, but the FANGs, I didn't have the chart this time here, were underperforming Russell 2000 for roughly 2 weeks, excluding the sell-off. The sell-off was stronger in the Russell 2000. And we have seen that the retail guys, they bought other things than the FANGs or the tech area. Now we have seen a little washout. It is completely open how it will continue. But let's assume that we have parallels to the 90s. There we had new markets in the US, and we had new markets in Germany and in some other areas, but these were the two biggest ones. And although everybody knew that this is absolutely crazy, what was going on, I give you here another example of Hertz. Hertz is bankrupt. The chart maybe doesn't show it, but we were at the price of below $1. And within a short period of time, you see the spike in volume, we went up more than $5. And then Hertz said, oh, by the way, we are issuing new shares, although they are filing for bankruptcy. And the background here is the Robinhood platform and the retail investor. This is a parallel to that time. It took more than 2 years to clear. And this euphoria there was across the globe. Here, in all stocks, here it is a very limited segment which are not touched by the professionals, and it's not the FANG area. Therefore, not knowing the future, but I would bet that when the dust has settled, this rally will continue, or at least the sell-off has a floor in the US where the Fed will intervene. So, long story short, probably it's going to continue.
Right.
Hopefully in a less how to call that, that the speed slows down, that it goes not up like every week 5-10% like we have seen.
Right. You mentioned the situation how the private investors sometimes outperformed the institutional. So then there is a question related to this. They are asking, will Robin Hooders stay in profit till the US election?
Sorry, who will profit? Sorry,
Robin Hooders, as they put it.
Hooders. I mean, assuming that this Robin Hooders guy will continue to speculate today, I read in the newspaper that a Chinese real estate company, I didn't memorize the name, but this is the new target of the Robin Hooders, was pushed up 12 times within 2 trading days. Unfortunately, I fear that continues because the washout didn't kill really these people or didn't cause too many margin calls. But what you mean by profit? I mean, some will probably write a book How to Get Rich by Trading. We have seen that 25 years ago. But once this is over, and don't ask me when it's over, gravity or valuation fundamentals play out. The key question here is rather, can Mr. Biden profit from it? Because Mr. Trump is really a poor manager of this COVID crisis, and with this unrest of Black Lives Matters, he has caused a global storm. It is completely open how this will end.
Well, this is true that the news wires today are overwhelmed with the news about the political activism events in the US and consequently in Europe. Do you think these events by themselves will affect the markets substantially?
This question was answered in a blog I followed, and basically what the person did there, they pulled up past events where there was riots in the US and what the stock market did, and if the real economy was affected. And the sad answer in terms of the actual situation is, although there are riots, although there are headwinds, the stock market moved on, and the impact on the real economy in terms of GDP or earnings was extremely limited. Therefore, as said, it is, but at the moment I would argue that the impact on the real economy is extremely limited. The hope is that in the political area there might be some changes.
Right. Well, thinking longer term, the OECD recently published the report that in the first 3 months of the year, the G20s, the economies of G20s dropped by almost 4%, and this probably the next worst comparison to that was 1.5% drop in the first 3 months of 2009 crisis. So we probably could be comparing this to something really remote back then. Do you think we could think of a possible depression coming up?
Oof, yeah. I mean, the key difference from now to 2008, or if you will, to the 30s, is this lockdown, this standstill was politically issued. It was a will. It was deliberately caused. And most guys I follow, they tell us that we will see a rebound, and a strong rebound once the lockdown is over. However, not all sectors will rebound in the same speed and go back to pre-crisis levels. I mean, one good example are airlines. On one hand, they will fly again, the prices are lower, the costs are higher, and they have less passengers. And the likelihood that they will reach the pre-crisis level within, let's say, 6 to 9 months, I would say zero. What will happen in 12 to 18 months? If you ask economists, they will tell you, well, we will never see this again, but nobody really knows, and I would not bet on that, because once there is a vaccine or a cure or both, people will forget. And you see in the US, in this early open state, they showed how people over the weekend went to the beach or were doing parties, and you see it also in the figures I have shown before. If I refind it here, the number of new hospitalization is higher than at the beginning of the crisis. So people really forget fast, and therefore I don't think that we will have a great recession or a depression because of the stimulus and because of the cause of it. This is not a financial crisis. Financial markets and the banks and insurance, they are in good conditions. We have obviously the widening of the debt to GDP in almost all countries in the world. And we have for sure misallocation and probably down the road bubbles in quite some areas. But having said that, I would argue that the outlook of the Fed, that this year it's roughly around 6% minus GDP, and next year, and this got completely forgotten in the press conference, next year he sees +5. Obviously minus 6 plus 5 doesn't give 100, but still +5. I don't know when people will focus on that bit of news, but as soon as that it gets into focus, then it's rather +5 and not where we stand on where is the starting point.
Well, with the outlooks on the developed economies being so grim, do you think the investors should at all look at emerging markets in the next year, or there are some attractive markets there?
Well, I would argue there are some attractive markets, and they come obviously with a risk premium. Risk premium can play out, or you can unfortunately short to mid-term get hit by the downside. I mean, I'm a fan of China A shares, and if you look at the development of China A shares, they were not even in a bear market. They didn't lose 20%. It is a bit tricky to get access to really A share and not H share and the quoted ADRs in the US or in Hong Kong, but that is definitely an area to look at. I see some recovery signs in some areas. I would be, for instance, careful on the bond and equity side for India. First of the COVID and second of the economic outlook. It also depends on the development of commodity prices, in particular oil. It is extremely volatile and it's still at levels where the production costs are hurting some countries, but not all. And down the road, if fundamentals play out, most, not all, but most of these emerging markets do have demographic development which is in favor of them.
Well, thank you very much for this really deep analysis and advices that you gave. I mostly liked the last sentence, one of the last sentences that you said, that people forget fast. Let's hope that not just people and investors will forget fast, but the economies also will forget fast and come back to normal as soon as possible.
Well, let me just say one thing. I think that financial history gets not enough attention, and I believe that when you are an investor for 30 to 50 years, you will re-see the same mistakes by new people, but still the same mistakes 3 times through your whole investment career. It is open if you will see it in advance or only in hindsight, but you will for sure see it 3 times.
Well, let's wish our viewers that this will not happen too soon. And let me remind that we had the hour-long conversation with the CIO of Blackfort Capital, Zurich-based asset management company, and that was a monthly macroeconomic overview that hopefully we'll repeat next month. Thank you very much, Andreas, and see you next time.